Hey everyone, welcome back to the channel where we break down market trends, charts, and patterns that could shape your investments. I'm your host, and today we're talking about a hot topic in the energy sector, the uranium squeeze that's set to intensify right here in 2026. If you're into commodities, clean energy, or just spotting the next big move, this is for you. We'll explore why supply is tightening, demand is exploding, and what it all means for prices and opportunities. Stick around, this video is packed with insights to help you stay ahead. First off, let's set the stage. Uranium is the fuel that powers nuclear reactors, providing a massive chunk of the world's carbon-free electricity. But after years of low prices following events like Fukushima in 2011, the market saw massive underinvestment in new mines and production. Fast forward to now, and we're in a classic supply-demand imbalance. According to industry reports, global uranium production only met about 74% of reactor needs in recent years, with the gap filled by dwindling stockpiles. But those inventories are running dry, and 2026 is shaping up to be the year when things really heat up. So, what exactly is a uranium squeeze? It's when demand outstrips supply so badly that prices spike as buyers scramble to secure contracts. Think of it like the oil shocks of the past, but for nuclear fuel. Analysts from firms like Sprott and Goldman Sachs predict that by 2026, mobile inventories, those old stockpiles utilities have relied on, will effectively dry up, forcing them to buy at whatever price is available. This isn't hype, it's backed by data showing a structural deficit that's been building for years. Let's dive into the supply side first, because that's where the pain points are most acute. The world's largest uranium producer, Kazakhstan's Kazatomprom, which supplies about 39% of global output, has slashed its 2026 production target by around 10%, down to roughly 29,700 tons. Why? Shortages of sulfuric acid, a key chemical for extraction, and delays in developing new well fields. On top of that, Kazakhstan is hiking taxes on uranium extraction, jumping from 6% in 2024 to as high as 18% plus extras tied to spot prices starting in 2026. This makes production more expensive and less attractive, especially for joint ventures with Western companies. It's not just Kazakhstan. Major projects worldwide are facing delays or cancellations. For instance, the Dasa mine in Niger is now pushed back to at least 2028, and projects like Arrow in Canada's Athabasca Basin could slip into the 2030s due to permitting and technical hurdles. Niger's government revoked permits for French Orano's massive Imouraren project, Africa's largest, with £550 million of reserves, and Goviex's Madaouela mine, wiping out potential supply of over £15 million per year. In Australia, the Jabiluka license was terminated, cutting nearly £300 million of future supply. Overall, we're looking at nearly £1 billion in cancelled projects this year alone. Even established producers like Canada's Cameco are dealing with operational delays at sites like McArthur River and Key Lake, further tightening the spot market. For 2026 specifically, estimates show mine supply dropping while reactor demand rises, creating an outright deficit. Primary output is projected to cover only about 3/4 of global needs, leaving a gap that secondary supplies can't fill anymore. Now, flip to demand, it's booming like never before. Nuclear power is having a renaissance, driven by the push for net zero emissions and energy security. China is leading the charge, approving 11 more reactors recently, with plans to triple capacity to 150 reactors by mid-century, doubling their uranium needs to £90 million annually. They've been stockpiling aggressively, adding £85 million in the last 2 years alone. Russia's drafting a plan for 34 new reactors, more than doubling their demand. India aims to triple capacity by 2031 and hit 100 gigawatts by 2047, a 12-fold increase in uranium requirements. In the US, the ADVANCE Act is paving the way for tripling nuclear to 200 gigawatts, adding £110 million of annual demand against domestic production of less than £1 million. Reactor life extensions in the US, Canada, Europe, and elsewhere are adding unexpected demand, think 20 more years for gigawatts of power. But here's the game changer, the AI boom. Data centers for AI and cloud computing are guzzling electricity, with global consumption forecast to break 1 petawatt-hour by 2026. Tech giants like Google and Microsoft are restarting mothballed nuclear plants to meet this baseload need. Forecasts show uranium demand doubling to 150,000 tons by 2040, but new uses in AI, defense, and robotics could strain supplies even more. Demand is projected to rise 28% by 2026, with supply meeting only 90% of reactor requirements. Geopolitics is fanning the flames too. The US ban on Russian uranium imports, effective since August 2024, redirects Western buyers to North American and Australian sources, deepening the deficit. Russia supplies about 20% of US enriched uranium, and with waivers limited, utilities are scrambling. The Dow's $3.4 billion RFP for domestic enrichment underscores the shift to secure, allied supplies. So, what does this mean for prices? Spot uranium is hovering around $82 per pound, but insiders are targeting $130 to $150, with some forecasts hitting over $110 in 2026. Long-term contracts are at 16-year highs of $81, up 37% in a year, with no pullbacks. To incentivize new mines, we might need $150 per pound, nearly double today's levels. Uranium developers could see 300% revaluations as the bull run kicks in. For investors, this is prime time. Companies with high-grade projects in stable jurisdictions, like NextGen Energy, Denison Mines, or even majors like Cameco, are drawing attention. ETFs like Uranium or stocks such as UEC and UUUU could benefit. But remember, commodities are volatile. Do your due diligence. In summary, 2026 is poised for a uranium showdown. Faltering supply meets surging demand from nuclear expansions and the AI energy crunch, all amid geopolitical tensions. Prices are set to climb, potentially reshaping the energy landscape. If you found this insightful, hit that like button, subscribe for more market breakdowns, and drop a comment on what you think uranium hits this year. Thanks for watching. See you in the next one.